Thank you, Tim, and happy to be here. Hope you're all doing well during these continued lockdowns all across the country. Certainly cooking a delicious meal at home with Marley Spoon or Dinnerly helps us here in the Weber household to have a bit of mental time off and just do something that's fun. So as we move on to the next slide. So Marley Spoon is now 6 years old, and we've demonstrated a strong growth trajectory. Obviously, last year was very, very strong with a nearly 100% growth. But this year we've guided the market and we've continued towards building this billion-dollar company by mid decade, and we're looking for a really big company by the end of the decade. And we continued with 30 to 35% net revenue growth this year. So when we move to the next slide, I just wanted to kind of step back a little bit and talk about what we do, where we come from. Not sure if everybody is familiar with how we operate. So our vision is to make a better everyday, specifically and highly personalized for each of our customers in just the right way. That means kind of with a balanced outcome, taking into account wellness, environment, and so forth, so in highly sustainable ways. And with our meal kit brands, we do that by bringing market fresh, delightful, and easy cooking back to the people. So next slide, please. And with our mission as well as our business model, we're really well positioned to capitalize on those mega customer trends and behavioral shifts. So on one hand, with Marley Spoon and Dinnerly, we're solving that, one of the hardest problems there is, which is what are you going to eat next week? And this is one of the problems that drives a lot of friction in every household, and we make that really easy. And we do that, as I talked about those consumer trends. So our service is highly personalized. We use AI to drive the pre-selection of our menu. We continue in an increasing variety. Our service provision is highly convenient. Cooking at home is being made, very convenient. We remove all the friction, but we're also helping our customers to have those personalized experience with their family, friends, partners, and so forth, delivering food education, learning, and all these things that are becoming more and more important as our customers shift to online, as well as digitize their personal lives through those moving life towards a mobile environment. But Marley Spoon is also well positioned to help our customers achieve their personal goals, and be that health and well-being through balanced nutrition, portion control, reduction of food, processed foods, and so forth, but also helping our customers to do their bit in their, through more conscious consumption, reduction of their personal carbon footprints. We have a very low food waste operating environment, and we help our customers to reduce their personal food waste. Our company is already carbon neutral operating, and we're continuing to making more and more steps towards achieving increasing levels of sustainability. Moving on. So, we do this in, for already some 270,000 subscribers, but we operate in a country, and we have a theoretical household reach of some 190 million households. So there is a huge opportunity and platform for our continued growth. But before we go there, just next slide, please. Wanted to give you a bit of an overview of our supply chain. And for those of you who are not kind of familiar with it just yet. So really a direct to consumer online, grocery experience business. And we are using a high amount of data in order to, on one hand, have a very efficient customer acquisition engine, as well as increasing the use of data to develop a highly personalized offer for our customers, be it through our mobile experiences, as well as, of course, through the menu selection. Our demand-driven supply chain, where we source most of our ingredients directly from farms, farm operators, that deliver straight into our facilities, our 8 facilities, around 7 facilities around the globe. And this reduces, a lot of waste, reduces a lot of cost, but it also is source to order. So there is, it is highly efficient, and we can personalize each individual customer box in very efficient ways because we've taken a lot of complexity out of that process. And then we deliver from our FCs, either line haul or last mile, directly to our customers, again, eliminating other value steps that are in normal grocery supply chains going via retail. Next slide, please. So as you can see, we're building a highly vertically integrated business, and we're moving into more and more steps. For example, we also have started small trials in Europe in doing some of the last mile deliveries ourselves. And we have a low waste operating model where, compared to groceries, we have next to no waste. And combining these internalizations of all these margin steps that normally go to other providers and bringing them in-house, with an opportunity over the long term to reach operating EBITDA levels of around 15%, which are vastly superior to normal grocery operators that you can see with supermarkets and so forth. So next slide. So based on our business model, as well as the large market we're operating in, and we've been doing it for 6 years, we have started to gain some traction. Already 70% of our net revenue is coming from customers that are ordering 6 or more, or have ordered 6 or more orders with us, and that is an increase of 5% over last year. And already 93% of our customers, of our net revenue, is coming from customers that have ordered 2 or more boxes. So you can see that what we call a Marley Spoon flywheel is gaining more and more traction. So we're increasing, we're growing our subscriber base. This increases the scale, leverage of our marketing activities, as well as leverage of our G&A. That then increases the profit on a per subscriber basis, allowing us to invest into digital as well as our operational capabilities and capacity, building a better customer experience with increased selection, increased personalization, more sustainable offering, and on it goes. So there's we have started to get that flywheel, if you like, spinning. So when you then look at the next slide. So our first half year financials are showing that we have grown over the first half year by 36%. Our net revenue, this is predominantly driven, of course, by Q1, which was not yet pandemic influenced in 2020, and Q2 we started to lap the pandemic, where we've grown some 10%. But more importantly, the profit from our repeat customers has outgrown our net revenue. And we continue to invest very heavily into increasing our customer base. So you can see over last year, an increase of 64% in marketing investments. However, the previous year was significantly lower than it would have normally been if there wouldn't have been that pandemic. Next slide, please. So here's another illustration of that flywheel getting some traction. So as we are growing, we continue to realize that operational leverage, for example, our marketing spend as a percentage of net revenue over the long term is reducing step by step, as we are acknowledging, of course, that the last 2 halves were significantly lower investments required given the pandemic influenced growth. But also our long-term spend on G&A as a percentage of net revenue is decreasing, albeit we needed to catch up a little bit with some investments because we kind of grew some 100%, and we're just catching up on right-sizing the business with the key investment areas in digital marketing, operational, as well as adding some key leadership positions. Next slide, please. Now, some analysts and investors, as well as ourselves, have asked us, so what would profitability look like at the phase of the business we're in if we were more in a steady state? And we can see that in a steady state, we'd be requiring some 10% of net revenue investing into marketing to replenish our customer base. But that would still then lead to a profitable business, be it this first half year, but also, for example, significantly profitable business over last year. Now we've made, and we make that conscious choice to significantly invest in growth because there's high and very attractive unit economics in attracting these customers. And of course, we want to build that €1 billion business over the next few years and continue our growth. So just finishing up, next slide, please. So there is, just quickly on here. So there's this increased growth investment that had, of course, an impact on our EBITDA this year. However, we have operated in H1 on a near break-even operating cash flow level. We've seen a slight decrease in our contribution margin. We held our operating contribution margin more or less steady. We would have hoped that we were able to increase those operating margins, but we experienced a few operational headwinds in the US. But the decrease in that contribution margin is driven by the significantly higher marketing spend that we have done this year. Now, next slide. Our growth strategies in order to build that big business are based on one hand, continuing to invest in these, building the base business. So that means acquiring customers in this under-penetrated market that we're already operating in. Of course, we want to increase our service offering by moving into more and more eating categories, and that then will increase the revenue per customer. There's opportunity over the next few years to enter other markets, of course, that we're not operating in, and move into adjacent categories. And we're already doing some trials by starting a very small scale, a pet food direct-to-consumer business in the US and here in Australia as well, called Bezzy. And we have an opportunity to make some disciplined acquisitions over the next few years and driving that growth. So there's a couple of more comments on the next slide. So we are continuing on our growth path. We reaffirmed our guidance of 30 to 35% growth. We're still having a strong contribution margin of 29%, and we continue on building scale and driving that operational leverage towards becoming very, very profitable on an operating EBITDA level. Thank you.
Thanks, Rolf. We've got a couple of questions here for you. Now, the market was probably surprised with your results because of that increase in marketing costs in terms of the cost of acquiring new customers. Is that a strategy moving forward? And how do you fund that? You have obviously a big competitor in HelloFresh. How do you compete with them, and how do you fund this client acquisition moving forward?
So the majority of funding these customer acquisition comes from our operating cash flow. In addition, with regards to strengthening our balance sheet, we've finalized the $65 million debt raise recently at very attractive terms for a business like ours. And with regards to the continued growth, these investments in customer acquisition are based on very attractive unit economics. So it makes a lot of sense to continue on that growth path.
So the idea is to potentially use that debt to continue to fund that client
Well,
acquisition?
not necessarily, but we'll provide more details on how we're going forward and what the growth rates will be as we move along.
There's a question here. Your first half results were impacted by multiple headwinds: supply chain disruption, inflation, labour shortages, etc., weather. Some of these will persist in the second half. When do you expect these headwinds to recede?
So there's a few things that we are working on in dealing with those headwinds. So and that will and should lead to margin improvements. So we have already in the US, where those headwinds are most prominent, implemented price changes, price increases that will have an effect. We are improving our internal operations, and that should lead to further margin improvements, and these will counteract towards these additions. But we also expect that some of these inflationary impacts in the US will normalize, and most businesses will of course react. For example, logistics partners will increase their capabilities as we move forward and so forth.
And Rolf, a good question here. Consumers love to buy online, but food is kind of lagging other sectors. How can you change consumers' perception about buying meals online?
So we believe that this shift from offline to online is a continuing shift. So pre-COVID, I think that was around 1.5% moving year on year from offline to online, and Woolies and Coles and all the others are demonstrating these numbers with I think it was around 25 to 35% year-on-year growth of their online businesses. So this is a continuing trend that we're capitalizing on. Now, the pandemic has, of course, accelerated that trend over the last year, where the online share of grocery nearly doubled in Australia and around the globe. And we just expect this to continue. A lot of customers have learned to trust the online delivery. And, I have a long experience in online e-commerce. So when I started my journey, the first part was selling shoes and jeans online. And I was faced with that same question: will customers ever buy jeans online? And of course, it's happening. And the same will happen with food. It's about giving customers trust and comfort that when we pick items for them, we do pick high quality items that they would have picked themselves, and then they will spread the word, as well as our marketing efforts to drive that customer base. So I believe that behavior shift will just happen on one hand naturally. And of course, customers are moving at a much higher rate toward digital means in fulfilling their experiences at home.
And can you just give us a rough idea as the last question, your target market and where you are with market share? So let's talk about the US, for example. Where are you in terms of market share, and where can you be moving forward?
So, market share is an interesting thing, and I don't think it actually kind of speaks to the opportunity for us. The market are customers that are buying their food in supermarkets. So comparing market share to, other players in meal kit or online groceries doesn't necessarily depict what's actually going on. So we're not taking customers away from any other player. We're convincing customers to change their behavior and then continue to stick with us. So while it's interesting to look at it, I don't think it reflects what's actually happening or where the opportunity lies. So it just goes back to this behavioral change. It goes back to offline to online move, which is happening at least at 25 to 30% year on year. And that is a significant amount of volume that's coming on the market that we're vying for.